Welcome, everyone, to the 2017 Employment Tax Year in Review. We have almost 5,000 registrants today. We're glad you could join us for today's Thought Center webcast. These webcasts are a series of live interaction events featuring EY's thought leaders. We have a fast-paced session for you today covering many federal and state developments to note for 2017. Tax reform is on everyone's mind right now, and to prepare you for what may lie ahead, we will also update you on the numerous provisions under consideration that would have an impact on payroll operations and employers. You can ask questions, make comments, or browse our year-end tips on Twitter at #EYYearEnd. I'm Christy Lowry, the National Director of the Employment Tax Advisory Services Group, and I'm thrilled to be in today's moderator. Before I introduce today's agenda, I want to let you know that we will take questions throughout today's session using the purple QA icon at the bottom of the interface. You have the ability on your desktop to send your comments and questions to us. We will try to get to as many as we can during our limited time today. We will have polling questions that appear throughout this webcast, and you'll need to respond to them in order to qualify for CPE or CE credit. So, if education credits are important to you, please keep an eye on your screen for these polls during the course of this webcast. If you are a CPP or FPC, you will need to answer polling questions throughout the webcast, in addition to a specific polling question toward the end of the webcast in order to qualify for RCH credit. If you respond yes to the RCH polling question, your certificate will be emailed to you within 2 weeks. In gratitude for your participation today, we're providing an extended handout file that includes today's slides as well as appendices of IRS forms and EY resources for tax reform and disaster relief. Be certain to download this file by clicking on the green resources list icon. Joining us today on our esteemed panel, we have several folks. First off, we have Stephanie Feaster, a senior manager in our practice.
Hello, everybody, and greetings from San Francisco.
Thanks, Stephanie, for joining us today. We also have Ken Hauser, an executive director.
Good afternoon, Christy. Pleasure to be here.
We also have Pete Berard, a senior manager in our New York area location.
Good afternoon, Christy. Pleasure to be here.
And we're also fortunate to have Lee Messina, a partner in our Work Opportunity Tax Credit Services.
Thanks, Christy. Looking forward to the discussion.
And last but not least, Debbie Salam, an associate director, who's going to be joining us looking ahead to 2018.
Thanks, Christy. Very happy to be here.
Before we start our discussion, let's review the agenda. During today's program, we'll talk about a federal update with Stephanie Feaster, and then we'll cover off the state update for unemployment insurance, some really important state and local payroll tax updates, as well as hot topics including paid family leave, and then also the Hurricane Disaster Zone Employee Retention Credit. And then Ken will follow up with disaster relief. And then last but not least, as I mentioned, Debbie Salam will cover off not only looking ahead to 2018 and tax reform, but our payroll year-end checklist. So with that, I think we should go ahead and get started. We have a full agenda, so Stephanie, we'll let you kick it off.
Hi, Christy. Thanks, and thanks everybody for joining. As Christy mentioned, I'm going to be covering some of the recent federal tax updates that have been announced for and will go into effect for calendar year 2018. In looking at the various employment tax rates and limits, as we would expect, we see an across-the-board increase in all of the items that have so far been released. The Social Security wage base has been announced at $128,400. And just an interesting anecdote with this, the wage base was previously announced at $128,700 back in the middle of October, but just on November 28th, there was an announcement that the amount was going to be reduced by $300 to $128,400. This is the first time, and our team was actually speaking about it before the call, that we have ever seen an announcement made of a wage base and then to have it actually changed a few weeks later. The SSA announced that the result and the cause of that was due to the increased amount of W2Cs that they received, which increased the Social Security wage basis for 2017. So again, going along, we expect the 401k limitation would be increasing to $18,500. Qualified parking would increase. Commuter highway vehicles would increase. And adoption assistance would increase as well. As you might know, and as we're going to talk about later on in the presentation, adoption assistance is one of those fringe benefits that is set to be cut as part of the new tax reform package. So we'll see what actually happens with that. Again, the health FSA has also increased, and there are still quite a few items that are pending that we have not, as of today, received any updates for. The federal unemployment insurance wage base remains at $7,000, and I can say in the many, many years that I've been doing payroll, that amount has never changed. So I'm not sure if we'll ever see an increase or decrease, but again, it remains at $7,000. So moving on to the limits for a health savings account. Again, we see minor increases across the board for all types of plans, for self, family, out-of-pocket, and then high deductible plans. We also wanted to point out one very important point is when you're doing and thinking about how you need to report employee and employer contributions on Form W2, you need to keep in mind the Box 12 Code W reporting requirements. Throughout the year, my team received many inquiries from employers about their failure to include those in the original Forms W2s issued for 2016, and there was a lot of discussion with employers about whether or not they should actually make adjustments and file W2Cs to include that. And the answer is yes. We do recommend highly that any W2Cs be prepared if the original amounts were not included in Box 12. And the reason for that is it can affect the manner in which the individuals will file their individual income tax return. So although it doesn't have a direct impact to an employer's payroll processing, it can have an impact on how an employee will file their individual income tax returns. Moving on to IRS Form W2 due dates. As many of you are acutely aware, I'm sure, the due date for paper forms is again this year, January 31st of 2018. as well as electronic filings need to be filed by January 31st of 2018. The due dates, most states we're seeing have adopted that expedited due date. There are a few stragglers that have not, but we see more and more states rolling in and adopting the federal guidelines so they would be in sync with the federal and state filing requirements. We do think, when I just spoke also about the Social Security wage-based decrease and the Social Security Administration indicating that it was decreased due to the significant amount of Forms W2C that they received, it could be possible that the increase in W2C forms were as a result of the expedited filing requirement for year 2016. So that might be an indirect impact of that. We can move on to speaking about a W-2 extension. If any of you are still impacted by the recent natural disasters that we have, you may request an extension for filing Forms W-2 by completing a Form 8809. That form must be filed by the regular Form W-2 filing date, which is January 31st of 2018, like I just mentioned. So keep that in mind, that if you're still having and you're still impacted by any disasters, that you do have a little bit of leeway to try and get those Form W-2 filed. Speaking about employee waivers of Form W2C, a little known fact, and one that I find that many employers are not aware of, that for de minimis amounts that need to be adjusted on a Form W2C, an employee may provide you, the employer, with a waiver whereby the employer does not need to issue a Form W2C to the employee. The de minimis amounts are $100 in any wage adjustment or $25 in any tax adjustment. The employee does need to provide that waiver to the employer in order for the employer to be absolved from issuing a Form W2C. Now, even if an employee does provide a waiver, the employer may opt to disregard that waiver and still issue the W2C. So just because an employee requests that a W2C does not be issued does not mean that you as an employer are required to abide by that, and you can still include that employee's W2C in maybe a greater population of W2Cs that you will be preparing. One interesting comment is a note is the IRS proposal to allow the truncation of Social Security numbers on Form W-2. Now, this is a result of all the data identity breaches that have come forth lately, and the truncated W-2 would be reported only on the employee's copy of Form W-2C. Any copies of Form W-2C, or excuse me, W-2s that would need to go to the Social Security Administration would still be required to show the employee's full Social Security number. But as you can imagine, just cutting down and allowing the truncated W-2s on the filings and electronic transmittals of W-2s to the employees could help to alleviate some of the employees' stresses regarding identity theft. The permissible format of the truncated W-2 would be that the first 5 digits may be replaced with either an asterisk or an X. So either manner would be acceptable and is up to the employer to determine which manner they would want to use. Moving on to when a prior year withholding adjustment may be made, we get quite a lot of questions and comments from our clients regarding any adjustments that they can make for a prior year withholding that may have been withheld or may have simply been erroneously reported on a W-2 or a 941. In general, the only instance where you can make an adjustment to a income tax withholding on Box 2 of a Form W2 or income tax withholding on Form 941X is when there is an administrative error. An administrative error is generally defined as when you make an error in reporting on those forms, but where the actual correct amount or a different amount was actually withheld. For example, if you withheld $1,000 of income tax from an employee's wages, but erroneously, due to a typographical error, reported $100 on a W-2 or on a 941X. That would be a perfect example of when the IRS would accept an adjustment due to administrative error. An administrative error is not when you withhold the incorrect amount of tax. So even if you have an employee that has a Form W-4 and let's say they were claiming Married 2 exemptions, but you erroneously withheld at single zero or some other amount, once the tax year closes and that W-2 has been issued, you cannot retroactively refund or collect that income tax from an employee if it was not withheld correctly in the first place. Instead, the employee will have to make any adjustments, either increases or decreases of that tax when they file their individual income tax return. So in essence, they will have to pay any additional tax due when the return is filed, or they will get a refund of any withheld tax when that return is filed. And recently, the IRS issued a chief counsel advice whereby they indicated that any gross-ups that were done on behalf of an employee, whereby the employer was paying taxes or withholding taxes on behalf of an employee, that the IRS is going to deem that as actually a withheld tax. So even if the employer is paying that tax on behalf of the employee and it was not theoretically actually withheld from the employee, the IRS is viewing that as a withheld tax and would not allow any administrative adjustments for that income tax withholding. Instead, again, the employee would have to make any adjustments for that tax on their individual income tax returns, and then a gross-up situation would likely have to refund back to the employer any refund that they receive as a result of the tax that the employer paid on their behalf. Now, the 941 instructions just this year in 2017 include specific guidance on this issue. So there were some misnomers and some different guidance that we saw within the industry about whether or not these gross-ups could be considered an administrative error. And interestingly, the IRS really specifically clarified that on the 941 instructions for this year. So moving on to FICA consents and statements. One issue we also see with our clients quite often is when a consent or a written statement must be obtained from their employees in order for an employer to claim a refund of Social Security and Medicare tax that may have been withheld. The IRS general requirements are that employers must make a reasonable attempt to collect employee share of Social Security and Medicare tax that might have been over withheld prior or in addition to claiming an employer over withholding. So in essence, an employer cannot simply claim their share of the tax without also giving an employee an opportunity to allow the employer to collect the employee share of those taxes. There are specific timelines when those requests must be made. Once an employer discovers an error, the initial request for an employee statement must be made within 45 days, and an employee must respond generally within that 45 days. And if they do not, a second request must be made, and then the employee has an additional 21 days to respond to that request before an employer can go ahead and file a refund claim for just their share of taxes. We do see that this is an issue that is often overlooked by employers, but again, we want to reiterate that there is a requirement that these consent forms be solicited from employees prior to employers merely obtaining or trying to obtain a refund of their own taxes. And then moving on to the specific types of consents, there is a written statement that must be obtained, and this is when an employer will maybe issue in advance an employee their share of Social Security and Medicare tax prior to the employer receiving or attempting to claim that refund directly from the IRS. Where we see this come into play quite often is when you have employee wage repayments, whereby an employee is repaying a wage, a bonus payment, or some other type of payment that was maybe included in taxable income in a prior period. So we get a lot of questions from employers about whether or not they should collect the gross amount from the employee or the net amount, net of FICA back from the employee. And what we generally recommend for administrative ease is that they go ahead and collect the amount net of Social Security tax and then obtain a written consent from the employee so the employer can go ahead and get a refund of both the employer and employee share, and then the employer, of course, would retain the employer's share of that tax since the employee received their refund via the fact that they only paid back the net amount to the employer. That is different from the consent, and that is whereby the employer will obtain a FICA refund from the IRS prior to issuing the employee share back to the employee. The statements and the wording on the statements are nearly identical to each other, but again, just be aware that you do need to get either a written statement or a consent depending on the specific fact pattern. And also, and staying on that same topic, but moving on to a new development in this area for year 2017, the IRS has added specific language as outlined in a revenue procedure whereby the employee must certify acknowledgement that the employer will not be claiming any refund of the Medicare surcharge tax, that instead the employee is going to be filing and remitting any additional tax or claiming refund of any over withheld tax via the filing on Form 1040X. So in essence, when you think about any employee refund for Medicare tax, you need to bifurcate the Medicare surcharge tax because that tax, similar to withholding tax, is taken care of and resolved directly with the IRS via the filing of an employee's individual income tax filing. Moving on to the last topic that I wanted to cover was with respect to the pilot program for verification codes reported on Form W2. The IRS is going to be expanding this to for year 2017. It's going to affect over 50 million Forms W2, so we may expect a certain amount of increases in employee questions regarding this code. And really the messaging is quite simple, and that when the IRS, when the employees are doing electronic filings, that they need to look at Box 9 And if that box 9 has a code, they need to merely input that code when they're doing their electronic filings. The information from the IRS indicates if the employee reports that code properly as indicated in box 9, it could decrease the processing time for processing the return by the IRS. But if they fail to report that item that is in box 9, the processing time would be really the same as any other filer that did not have anything to report in box 9. So again, it's fairly simple that they just need to report that if they have a code in box 9, that they just need to go ahead and include that in the electronic filing as requested. And Puerto Rico already has a similar authentication code, so any employees in that area or from Puerto Rico would generally already be familiar with the requirements for that.
Fantastic. Thank you, Stephanie. I think we have a polling question now. Our polling question is, has the earlier Form W2 filing due date increased the number of forms, W2C, that you provide to employees and file with the SSA in state and local jurisdictions? Please choose the answer that correctly identifies you, and we will have those results a little bit later. And in the meantime, we will have Ken provide us with an unemployment insurance update.
Thank you, Christy. I know everyone's waiting for our tax reform update, but before we jump to that, we have a lot of activity on the state and local side, so I'm going to jump in on the unemployment taxes and then turn it over to Pete for some other state and local payroll tax updates. With respect to unemployment across the board, we're seeing unemployment come down across the country. We're finally starting to level off since our last recession. As you can see, we have 21 states, however, that have increased their wage bases in 2017. On the flip side, we have 46 states that have either decreased their base tax rates or not changed their rates at all. So we see these contrasts across the wage base and the tax rates. The states that have the highest wage base, as you can see, is still Washington at 45,000, and we still have these few states that are somewhat linked to the federal unemployment wage base of 7,000, Arizona, California, Florida, and Puerto Rico, to name a few. I think the one trend on here that I really wanted to highlight is you can see that there's been 20 to 25 states in the last 5 years, year over year, that have increased their wage bases. I think this probably has to do with two different factors. One is states trying to avoid what happened in the last recession, where we had back-to-back recessions and the funds really just were depleted across the board, and states started borrowing against the federal unemployment funds. And then two, even though, as Stephanie mentioned earlier, there really hasn't been a change in the federal unemployment wage base since anyone can remember, there has been rumors that that is going to happen. So states may be trying to be proactive and increase their wage bases ahead of that potential increase on the federal side. Few to credit reduction states. I can remember doing this slide on webcasts for 5-10 years now, and I think this could be, we're down to 2 states now. So we're from the 20s down to 2, and it's the same 2 states from last year. We have California and the Virgin Islands. And what this means is that employers with employees in these 2 states will pay a higher federal unemployment tax. So if you're out, for any employees outside of these states, you're still paying 0.6% on the first 7,000 of wages, so $42 a person. For employers with employees in California or Virgin Islands, you're actually paying an additional $105 per person. And again, these are the same 2 states from last year. We do believe that in 2018, California will finally pay off that original loan balance and might drop from this list as well. Quickly, just looking at the bar chart to the right here, we can see, and this kind of alluded to what the point I made on the last slide, is that in 2012 we had almost 20 states that had outstanding loan balances on November 10th of the calendar year. In 2016 we were down to the last 2. In 2017 we still have the same 2. Hopefully in 2018 we'll be down to the Virgin Islands. Even though states have paid off their original loan balances, we still have 6 states in 2016 that have outstanding interest or bond assessments on those original loans. So in 2016 we had 7 states. We're now down to 6 states, but I think we're going to see a couple of years before all these states drop off on their interest and bond assessment payments. Looking at the unemployment rate or the jobless rate across the country, the national average actually dropped again from 4.7 down to 4.3, and that was from May 2016 to May 2017. And as you look at our chart on the slide, we have the top 10 highest jobless rates against the top 10 lowest jobless rates. So folks in Colorado, rest assured you're at the lowest at 2.3%, while Virginia and Puerto Rico are above 10% at the moment. One last item to mention on the unemployment tax perspective. Statutory elections in Connecticut, specifically joint accounts, are going to be dissolved as of January 1st, 2018. So to refresh your memory, a joint account is when companies have multiple payroll IDs in a particular state. Some states, approximately 11 or 12 states across the country, permit what's called the joint account election. This election allows companies to combine the tax rate factors to come up with a lower overall net cost on the unemployment tax side. Connecticut, due to staffing, actually will not be able to keep up with this. So I guess most systems on the state side are pretty antiquated. So it's a pretty manual process for Connecticut. So beginning in January 2018, joint account elections will no longer be permitted, and those companies that have elections in place will be dissolved effective January 1st, 2018. Christy, I believe we have the first polling results.
We do, and it looks like most folks have the deadline under control, in that a majority, 52%, was the answer to no, they have not seen increased number of W2Cs. And then next we had yes slightly at 33%. So that's great news. Everyone is doing what they need to do. And with that being said, Pete, why don't you give us an update on state and local payroll taxes?
Okay, thanks, Christy. Good afternoon, everybody. Jumping right in, one of the main topics that we're touching upon here is State Form W2 due dates. Most states in the union have adopted the earlier filing date of January 31st. However, exceptions to this rule do apply, and those are listed in the 6 states below, which are keeping their filing deadlines at February 28th. Hawaii, Michigan, New Jersey, New Mexico, Oklahoma, and West Virginia are those 6 states. Moving on, in terms of our state income tax withholding tables, there have been some updates since the beginning of the year for 5 states. 2 of those states, Kansas and Maine, had their changes effective as of January 1st of this year, while Idaho, Illinois, and New York City had changed their tables in July of this year and were effective at that time. So be sure you are using the correct tables for those particular jurisdictions. Moving on to state and local payroll tax trends, there are a number of drivers for new and increased payroll taxes. This year we have seen a historic level of activity for state and local payroll taxes, with the drivers for new or increased taxes being health care, child and dependent care, paid family leave, and revenue to fund transportation infrastructure. These are trends that in many cases will continue in several years. So jumping into the topic here, Alaska, the governor has pushed again for a personal income tax in that particular state. In recent years, last year the governor had pushed previously for a 6% personal income tax rate in 2016 under House Bill 4004. However, that was not successful. His most recent attempt has been calling the state legislature into a special session in October of this year, trying to enact a proposed tax. However, not successful again, but it's expected that Governor Walker will make an attempt next year. Under the tax that was proposed, it would have effectively created a 1.5% withholding tax rate, referred to as a modified head tax, on the wages of both residents and non-residents and self-employment income, capped at the higher of either an annual withholding amount of $2,200 or twice the previous year's permanent dividend fund amount. For those of you who might not be aware, the permanent dividend fund is paid to Alaska residents who were within Alaska for the entire calendar year and intend to be a resident indefinitely. So I've probably given you more information than you know about Alaska already. Moving on. Maine had made a couple of attempts this year to create a universal family care tax. 2 bills that were considered by the legislature would have created a universal family care system funded by payroll taxes, which would have been levied on employees and self-employed individuals who are earning in excess of the Social Security wage base. Currently, that's $127,200. Under each of the proposals, the payroll tax would have been applied at a rate of 12.4%. So essentially, just like Social Security, and currently that the employer would withhold 6.2%. The employer would pay 6.2% from the wages of the individual, based on the wages of the individual, or a self-employed person would pay the full 12.4% on the covered earnings. One thing to keep in mind is that this tax would have also been assessed against unearned income, very similar to the net investment income tax that is established under the Affordable Care Act. Moving along to Massachusetts. Massachusetts has made some changes recently to its EMAC tax, its Employer Medical Assistance Contribution, so that effectively on January 1st of next year, 2018, a second tier is created that will potentially add an additional 5% of the tax per non-disabled employee if that employee has signed up for a public health care plan rather than the employer's plan. Under this 2-year plan, it will establish a rate increase for the EMAC, but that will be offset significantly by a unemployment insurance rate decrease over the same period. So as we have noted here, the employer EMAC taxes are expected to increase by about $200 million in total, while there will also be a $335 million decrease overall in the employer unemployment rates. The EMAC is applicable to all employers with 6 or more employees, and that at its maximum will be applied at a rate of 0.51%, up from the current 0.34% for fully subject employers, meaning employers that are subject for year 6 or over, and that will raise the cost per employee from $51 to $77. New York. Paid family leave. This is a topic that has been kind of bandied about a bit for between our clients and ourselves here in the New York office. That under a law that was passed in a couple of years ago, effective January 1st, 2018, paid family leave replacement wages will be available to qualified employees who take time off to bond with a child, to care for a close relative with serious health conditions, or to relieve family pressures when someone is called to active military service. Now, the benefits are paid under a newly established paid family leave insurance program administered by the New York State Workers' Compensation Board, and the premiums are paid 100% by employees through after-tax payroll deductions. This insurance can be carried with the New York State Fund with a private insurance company, or the employer can maintain a self-insured plan. However, one thing to consider is that New York has issued a notice on this, notice N-17-12, that came out in August of 2017, and unfortunately it seemed to raise more questions than it answered. But we're definitely seeking to get more information from the state on that particular issue. Another thing to keep in mind is that in order to get the law up and running, the state statute did allow employers to start making payroll deductions effective January 1st of 2017. That rate of those deductions is 0.126% of an employee's weekly wage, up to a maximum of $1.65 per week. For more information on the paid family leave in New York, Ken will be covering that further in our next segment. Moving on to Oregon. There is a transportation tax that has been put into effect in Oregon, which will be effective at the midway point of next year. That payroll tax will be used to provide upgrades to the various state highways in Oregon. Under the new law, employers will have to withhold 0.1% of the wages of resident employees and non-resident employees working in Oregon, and this tax will be remitted with withholding to the Oregon Department of Revenue. However, the tax will effectively be deposited into a new transportation improvement fund. Employers will not have to match this withholding, but it is expected that this will create probably a combined filing with the existing quarterly employment tax returns for withholding, and there's also a new annual return that is required for this particular tax. Another item on Oregon is that effective earlier this year in October, there was a new earned income tax credit notice requirement for Oregon employers regarding the availability of Oregon and federal earned income tax credits. The requirements under that bill require that the notice be in English as well as the language predominantly used with the employees for that particular employer. It's included annually with the Form W2 starting in 2017, and the employers must also provide federal and state earned income tax credit websites where employees can find more information for themselves. Moving along to Washington, another state with paid family leave law, beginning in January 1st of 2020, very similar to New York, that there will be paid family leave benefits available for an employee who is bonding with the birth of a child or the placement of a child via adoption under the age of 18. Also due to family members' serious health conditions or military exigencies. The benefits will be paid under a new program that is administered by the Washington Employment Security Department with premiums that are paid about a little more than a third by employers and a little less than two-thirds by employees. This will effectively be administered very much like a state disability insurance tax where each side will be paying some in. And that in order for to fund the system before the effective date, effective January 1st, 2019 through December 31st of 2020, a premium rate of 0.4% will be in effect, and it will be taxed on an annual wage-based limit, very much like Social Security, and that will also be the amount that is used as the base each year. That will be the maximum. Staying in the state of Washington, some developments in one of my favorite cities, Seattle. There was an ordinance that was passed recently that was effectively trying to tax income of residents earning over $250,000. Resident individuals earning over $250,000, as well as joint filers earning over $500,000 to pay an additional income tax, to pay an income tax of 2.25% on total income. While there would be no income tax withholding requirement at the time, and the income levels would be adjusted annually after 2019 due to inflation. However, this ordinance was recently struck down as unconstitutional by a trial court under state law, which prohibits a municipality from establishing a local income tax. And as we have noted here, the law states a county, city, or city-county shall not levy a tax on net income. The city tried to argue that the tax was to be applied to total income as opposed to net income, but was unsuccessful in that argument. The city has stated that it will, through its new mayor, has stated that it does intend to appeal this decision. So we'll have to see what happens with that. And one thing important to note is that Washington State is one of our 9 states that do not currently have an income tax. With that, I'm going to kick it back to Christy for our next polling question.
Thanks, Pete. That's some really great state update information. For those of you in those states that do allow for private insurance, we'd like to know, how are you currently meeting your family leave insurance requirements? We will give you about 2 minutes to answer this polling question, and we will return back with the results after we hear from Ken with some more information on paid family leave. Ken?
Thank you, Christy, and thank you, Pete. Pete had mentioned in his presentation the states of New York and Washington, and New York being effective January 2018, and Washington, the withholding piece, being effective 2019, benefits paid in 2020. Here we wanted to show you now just a list of the states that either have already enacted something or something that is on the books for a future date. Paid family leave is becoming a very popular requirement at the state level. You can see California started us off in 2004, New Jersey followed in 2008, and then and Rhode Island came in 2014, and then besides Washington and New York, we've got D.C. that has something pending for 2020. The other complicating factor here is that in addition to states, we also have localities that are passing similar legislation. For example, San Francisco has added to the California state benefit effective January 2017 to provide for 100% of wage income in addition to what the state benefit is. Similarly, other localities or counties, I think in New Jersey, have passed local legislation to include paid family leave for those jurisdictions. The other complicating factor, thanks to New York, is that besides New York, every plan is administered through the unemployment agency. Now that New York's in the mix, they're administered through the Workers' Comp Board. So, again, just another factor that makes things a little more complicated. Not only that, but how the benefit is paid and collected lacks uniformity. For example, is it employee-funded or is it employer-funded? Finally, every state except for Rhode Island allows for a private insurance carrier to pay the benefit. One misnomer is paid family leave often gets confused with disability. While there are some similarities, the New York announcement created a lot of confusion in this area. It's important to note that paid family leave does not meet the definition of an exempt health or accident plan benefit. Accordingly, it is not exempt from federal employment wages unless paid by a state fund. So if you can see on our chart here, PFL is only exempt from employment taxes, Social Security, and FUTA taxes if it's paid by a state fund. Otherwise, all employment taxes would apply. For those that are using a third-party payer for their PFL, a couple things to consider. The first thing is, will the third-party provider withhold tax and report on Form W2? If they won't, how will you reconcile if an employee comes back and asks why he's not receiving Social Security credit for wages for those time periods? Also, have you explored with your third-party payer the potential risks and how do you avoid those risks? One thing to consider is if you can go to the IRS for a private letter ruling, because this is a pretty new area, so there really isn't much definitive guidance in this area. At this point, we're going to turn it over to Lee, who's going to introduce Hurricane Disaster Zone Relief.
Thanks, Ken. Appreciate that. Yes, we're just going to pivot for a few minutes here and talk about the Hurricane Disaster Zone Relief, which was really put forth into law under H.R. 3823, so the Disaster Tax Relief and Airport and Airway Extension Act of 2017. So a little bit of a mouthful there. But that was signed into law just a few months ago in late September, and the act itself provides a broad array of relief measures focused on individuals and businesses affected by Hurricanes Harvey, Irma, and Maria. We're going to spend the next few minutes here on one specific relief within that legislation, which is the Hurricane Disaster Zone Employee Retention Credit. And that's a federal income tax credit for businesses with inoperable work locations in the disaster areas that continued to pay their employees despite hurricane disruption. And we'll unpack that here in just a minute because it's got a lot of key definitions within that statement. But this legislation itself is really modeled after previous employee retention credits. Most notably, after the Gulf hurricanes of 2005, they came out with the Gulf Opportunity Zone Act, which also had a similar employee retention credit. And that's important to know because right now the only guidance out there is really H.R. 3823 on this relief. We'll wait to see if they're going to be issuing further guidance, but right now we've got previously issued FAQs and previous guidance on some of the earlier legislation. So why don't we unpack this credit just a bit further here, and we'll talk about some of the key provisions on the next slide. To cast a further framework first, though, it's important to speak to a few different key definitions. And so if we think about this tax credit, it's generated by wages paid during the following period. And that period is when a trade or business first became inoperable at the principal place of employment of an employee immediately before the hurricane, and that period's ending when that trade or business resumed significant operations. And so try to keep those definitions in mind as we talk through some of these key provisions. But with the credit amounts, on its face, it's 40% of qualified wages, and that qualified wage base is up to $6,000. The maximum credit amount then is $2,400. And that may sound familiar for some of you that are taking the Work Opportunity Tax Credit, which has a similar calculation to it, at least for the majority of the categories that fall under WOTC. This has some relation to that as far as the calculation goes. Now, speaking of the WOTC cannot be claimed on the same period of wages, but can be claimed on the same individual if you're looking at employees that could be eligible for both credits. So that's important to note as well. Why don't we move along to several other key provisions? And again, as we talk through this slide, the credit itself may look simple on its face, but it really does have several different technical nuances to it that are important to clarify. And so as we look at eligible employers, it's really any employer that's residing within, or that has a facility, I should say, residing within a disaster area. And we'll show you some of those disaster areas here in a moment. But beyond that, what does that inoperability term that I used, how can that be defined? And we actually had the opportunity to meet with IRS and Treasury back during the Gulf Opportunity Zone around the previous legislation and had some discussions around understanding triggers for inoperability and how we determine a reasonable basis for how operations are measured. And so in that discussion, it really came to light that it doesn't have to be physical damage to the employer's place of business, while it absolutely can be, and that would definitely qualify for inoperability, such as anything from broken windows to total destruction. There's other things to look at. And so indirect physical damage is also something to consider. So whether that's loss of power, the business is physically inaccessible to employees, there's hazardous surroundings, those would be examples of indirect physical damage. Economic damage is something that's also very important to look at, whether that's loss of customer base, loss of production, sales decrease. All of those triggers could be eligible to be definitions of inoperability and how that is measured. So if we look at eligible employees as well, this is an employee whose principal place of employment on the applicable date, which we'll share those dates here in a moment, was in a Hurricane Harvey, Irma, or Maria disaster zone. And that's important because, again, that dictates the population of employees whose wages could be eligible for this retention credit. And then lastly, on qualified wages, these are essentially wages that are subject to FUTA, and they're going to be the wages that were paid or incurred on any day after that applicable date for the respective hurricane and before January 1st of next year. And then in addition, you've got to look at that inoperability period that I was mentioning previously, which again looks at during what time was that business rendered inoperable and before they resumed significant operations. Now what's interesting about that is, based on prior guidance, those qualifying wages could be wages that are paid to an employee who performs services at a place other than their normal work location. So it doesn't mean your employees were not working at all. They just may simply be working at an alternative location that they were not typically assigned to. Or alternatively, they could be going back to their original work location, but not all of the workforce is back. So again, looking at the resumption of significant operations, perhaps those wages could still count. So really that definition and that measurement should be looked at each principal place of employment separately. So it's really a facility by facility evaluation when you look at inoperability, when you look at qualified wages, et cetera. So there's no single answer for employers, but they should use a reasonable and good faith interpretation around what significance means there. So very important things to note. So if we move along, the disaster zone covered areas are listed here as far as the different states and jurisdictions that are included by county for the 3 different hurricanes. And so essentially the work location to be eligible must be posted by FEMA as a major disaster area eligible for individual assistance or individual and public assistance. So it is quite a few counties. You'll have this information. You'll see that some of the hurricanes actually overlap varying jurisdictions as well. But that's the beginning point to make sure that you're located in one of these to then continue with the evaluation. And then lastly, we've got the coverage period. So again, as I mentioned, applicable dates throughout our earlier comments, you'll see those applicable dates here on that first row, so the August 23rd, September 4th, and September 16th. If you are an active trade or business on this date, then qualifying wages could begin as early as that second row of dates. And that's very important because, again, that's really where your inoperability window could last. And then, of course, you'll see that could go up through December 31st. So we do have, for instance, Puerto Rico locations that may not be back up and running, and therefore qualifying wages could still be accruing there. Another thing to consider, too, with this, when you look at these dates, some of this time allows for evacuation considerations, even if the business did not technically close. And so, again, if you're evacuating, you're experiencing business disruption, and that should be reviewed for this retention credit purpose. So bottom line, if you have a facility located within the disaster area, this really is something that's worthy of further exploration for your business. So Christy, I will turn it back to you at this time. I think we've got some more polling results.
Thanks, Lee. With such an active hurricane season, and it seems like so many employers were impacted this year, this is really great information. But our polling results from our last question, it looks like most of you are self-insured, 45%. And for those of you that are not self-insured, 35% of you use the private insurance company, and only 20% actually utilize the state fund for your paid family leave insurance. Interesting. So with that, Ken, you want to cover off disaster relief?
Sure. Thank you, Christy, and thank you, Lee. Lee covered some amazing employee credits, and we've seen companies become eligible for lots of credits in that area. With that said, there are some additional benefits for both employees and employers. The first being if a company were to set up a tax-exempt charity or foundation, and again, they would have to qualify under the rules and eligibility there. However, if they were to do that, any donation that comes in from or through that charity then becomes a tax deduction for that individual that donated that either leave or money. Under Internal Revenue Code Section 139, and this is whether you're in an emergency area or a major disaster area, and we'll talk about that distinction a little bit when we go through these five, or actually five, but there's really six additional benefits we're going to talk about. But under Internal Revenue Code Section 139, any granted money here through a qualified emergency or major disaster area will become immediately tax-free to the recipients. And again, these would be for qualified expenses as discussed in Section 139. Some of those would just be your necessary personal family living and maybe even funeral expenses if unfortunately that were the case. These could be distributed to the employee or a third party, and our recommendation is that you actually have the employee sign a statement about what was received and what it was for, because these contributions to them have to be above and beyond what may have been paid by an insurance company, FEMA, or some other charitable organization. Another potential benefit is leave sharing. So your employees can donate paid time off to impacted employees, and this way there's no direct cost incurred by the employer. Of course, the employer needs to have a written plan in this area. The leave is actually taxable to the recipient, and the donor cannot take a charitable deduction for that leave sharing. And then leave cannot be converted to cash either. However, under Internal Revenue Code Section 170, there's also what's called leave-based donations. Here, an employee can elect to have their employer donate the cash value of that same paid time off to an IRC Section 170C charitable organization. Under that scenario, the donor value of the leave is excluded from wages. Additionally, employees cannot claim a charitable deduction under this situation. Employers can, however, deduct that leave on their books. Also, this is not reported on Form W2. Qualified retirement plan relief is another area under Announcement 2017-13. This aims to make it easier for affected individuals to obtain a plan loan or hardship distribution if they were in an impacted area. Finally, there's disaster unemployment benefits. Here, if an individual put in for unemployment under regular unemployment benefits and was denied, they could then put in a claim under disaster unemployment insurance. For emergency areas, again, not major disaster areas, and we've listed them here on the right hand of the slide, Internal Revenue Code Section 139 benefits apply, and any contributions through a tax-exempt foundation or charity would apply. However, the other 4 benefits that we discussed would not apply. These would only apply in a major disaster area, and as you can see on this slide, we have indicated those on the right-hand slide as well. We do have, under our EY Resources tab, additional information that can be accessed that has more detailed provisions on disaster relief. So with that said, planning for the future. I think if an employer does not currently have a tax-exempt foundation or charitable organization set up, it's probably a good thing to do. Also, disaster relief policies. A lot of these only become tax-exempt or deductible if there's a policy in place. So if there aren't currently policies in place, it's time to start looking at your policies and put those in your plan. Finally, without an emergency employee response system, it'll be very difficult to identify not just the individuals that may be impacted and need the benefit, but also to obtain the credits that Lee discussed. It would be good you can use that same information collected through the employer response system to indicate where you may have some credits to take advantage of. Christy, I think we have another polling question.
We do. Now that you and Lee have both educated us on disasters and hurricane disaster zones, we'd like to know if you plan to apply for the Hurricane Disaster Zone Employee Retention Credit. A, yes. B, no, even though we have qualified locations. C, I'd like more information. Or D, don't know or doesn't apply. So while we are waiting for the responses to that question, the moment all of you have been waiting for, from Debbie Salam, looking ahead to 2018, and what can we look to for tax reform? Debbie?
Hi, Christy, and again, I want to thank everybody for joining, and just have to say, when I saw the House bill, I was shocked. I've been in the industry for a very long time, have never seen a piece of legislation with so much potential impact on employers. So I have to make that comment. It's a lot. The Senate version is less severe, but again, we really don't know how the House and Senate will negotiate their differences at this point. So by way of background, both the House and Senate have passed their separate versions of the tax reform bill. What you're looking at on this slide is actually the table of contents in the EY resource section. So we wanted to make it very easy for you to navigate all of these provisions. So on that, in the resource section, you would just click on each of the topics and it will take you directly to a page that will give you all the details about what the House version is and the Senate version and what those implications would be. But let's just go through this quickly. The House would like to see us eliminating completely the tax-free status of employer assistance adoption assistance programs. So those would no longer be tax-free when provided by the employer. Dependent care assistance would lose its tax-free status, I think effective 2023 is what the House proposed. Educational assistance would no longer be tax-free. Employee achievement awards would be taxable. And then the Senate tacked on some other provision that if an employer gives a gift card or cash as an achievement award, that wouldn't be deductible to the business. Employer-provided housing would be subject to new annual limits. Right now there is no limit. Medical savings accounts would be done away with. Both the House and the Senate would like to eliminate the deduction for employer moving expenses. Of course, right now, you can deduct for moving of household goods and personal effects, mileage with a limited rate, obviously, mileage to and from the old place of residence to the new workplace. So whatever is still remaining as something you can reimburse on a tax-free basis would essentially be eliminated. House and Senate both agree with that, but the House would allow that provision to expire effective January 1 of 2026. And there's a lot of that going on. We're very unsure. Some of these provisions, the Senate would have them expire after a certain period of time. So it's going to be curious to see how that shakes out. On qualified retirement plans, there were provisions that would have done away with catch-up contributions. Fortunately, those were struck by the Senate bill, as well as some other measures that would have created conformity between public and government qualified plans and 401ks. Those provisions were struck from the Senate-passed bill, but we probably will see some provisions around hardship distributions and loans and things like that to make things a little bit easier for employees. So those things seem to be in both the House and Senate versions. The other thing that we're seeing is a theme of disallowing business deductions. So, for instance, disallowance of deduction for athletic facilities. The Senate wants to disallow the deduction for eating facilities at the employer's workplace for the convenience of the employer, an elimination of entertainment expenses, and elimination of the deduction for transportation fringes. So they would still be not taxable to employees, but the employer wouldn't be allowed to claim a deduction. There was a provision for worker classification, a safe harbor for the gig economy that was in the earlier Senate version that has since been struck. So I don't know if that's going to come back maybe in some future legislation, but it's at least right now not in tax reform. The House would like to see a new quarterly wage report that is, with the 941. For instance, you would provide details about all the employees and their wages that comprise that 941. This is something every time there's a major tax bill, somebody tries to get this one through. I'm hoping it doesn't. It has failed in the past, but it is there again. Another provision basically on the individual tax side that would disallow a deduction for unreimbursed business expenses. That's something employers will want to watch, and the reason is because if employees will no longer be able to claim a deduction, some employers will need to rethink about those expenses that they aren't reimbursing for their workforce. So, you have to look at what's happening in tax reform both for individuals as well as businesses because there are those implications in terms of employer policy. On the Senate side, we would see a nice reduction in supplemental wage rate, dropping from 25 down to 22%, and then for over $1 million, dropping from 39 to 38.5%. So if the Senate gets its way, there could be some savings for employer gross-ups for sure. The sad part about the Senate bill right now is that those reduced tax rates would expire at the end of 2025. So not sure, again, how reconciliation will play out. On the business tax credit side, our favorite topic, Ken and Peta both talked about paid family leave. The Senate is offering a business tax credit for paid leave that employers provide to their employees. There's various restrictions that would be placed on it, but here we see at least Congress trying to get in there and offer some kind of a reprieve to employers who they understand are being certainly very hard hit with this new trend among state and localities of mandating various types of paid leave. So that's tax reform. Please go to your handout in the EY resource section and check out all of the details there. So let's move on now and look at some other things that are going on. They're not tax reform, but they're trends that we want to watch. One of them is because of the recent Equifax situation with the exposing of a lot of Social Security numbers. There's a lot of hearings going on at Capitol Hill, and the conversation is to eliminate the Social Security number in favor of a national ID system that would expire periodically. I think some are saying something that would expire every 3 years. Now, this isn't something that would happen tomorrow, but whenever it does, if it does, just imagine what kind of implications that would have on payroll and HR. So we want to keep a close watch on that. And then moving on to family leave insurance, again, we see this very hot topic. Congress, again, trying to address how to alleviate employers the burden of all of this activity happening at the state and local level. And one bill that's gaining some momentum, at least with the Republicans, would give employers the choice of providing minimum paid leave and flexible work options or complying with state and local paid leave laws. So a preemption of state and local law. Obviously, this is going to be a provision that will be fought by states and localities that want to preserve their rights to mandate things as they wish. But a lot of activity on the paid leave front. Unfortunately, nobody coming up with legislation to clarify how to tax paid leave insurance benefits. We're certainly hoping somebody moves in that direction pretty soon, for sure. Going on to the next slide. I do want to point out that the IRS administration, in terms of enforcement of penalties, if you've had more than one offense, your ability to get deposit penalties waived is very, very difficult and almost impossible anymore. About the only way to get those waived is to actually move to go into a court settlement with the IRS. So this has been a recent development. It has definitely affected, I know, the clients that we work with, draconian penalties, which in the past might have been negotiated, no longer being negotiated. So we're not really sure if this is a change of event that would be something the Trump administration might look at and direct the IRS to go back to a history of more lenient policy on penalty abatements. The overtime situation, of course, in the Obama administration, there was a change in the overtime rules that would have required the exempt amount to be higher than it is currently. A federal district court in Texas, of course, put a halt to that. And now what we have instead is a comment period requested by the Trump administration on what basically employers feel about the current overtime rules. So what we could see is a change in the overtime rules, but not really quite sure when that might happen, but that's still a possibility in the future. So that is a rundown on what we're looking ahead for the future. And before we go to the payroll checklist, Christy, I believe we have the results of that last polling question, right?
We do, Debbie. Thank you for that. Looks like majority of you 43% plan to apply for Hurricane Disaster Zone Employee Retention Credit, which is fantastic. Unfortunately, as I mentioned, several employers were impacted by this, but only 38% of you actually said no, even though you have qualified locations or wages. So with that, I think we will move on to the last but not least topic, Debbie, our payroll year-end checklist.
Yes, and again, I do want to point out, we'll talk about this a little bit later, but our annual year-end checklist is updated out on EY.com, so it's available digitally and for download, and we'll show you that slide in a minute. But one of the things that just must be emphasized, Christy, it's so important with the acceleration of the W-2 due dates at the federal and state level, and Pete, as he told you, there's only like 6 states that aren't accelerating that due date, we do have to really focus on reconciliation because there has an uptick in corrections. And one of the things that happens when we're correcting W-2s is that we're not going back and handling that reconciliation, making sure W-2s balance to the 941 or the state reconciliation returns. So let's go through the steps, if we will. First of all, very important, be sure you're conducting a jurisdiction review. This means that you're matching employee work and resident locations to make sure that you have income tax withholding happening where required and that you're finding returns for those areas. So that's the first point of reconciliation. The second is verifying system accumulators. Now this is very important. You want to confirm that all of your year-to-date accumulators that you're maintaining in your records and lists are matching your third-party system or systems. There may be more than one system that you're using. And then third, and very important, wage and tax data reconciliation. And this is tying your federal wage and tax information, understanding that you should be reconciling back to state and local. Now, reconcile doesn't mean that the dollar amounts agree, but it does mean that you can explain those differences. Okay, let's go to the next slide, talking again about that W-2 to 941 reconciliation. This is where a lot of companies miss it, and then maybe several years later, and it does take several years, here comes the Social Security Administration, and here's some penalty assessments. So remember, not only initially when you do your initial filing of W-2s to 941s, you do have to make sure they agree, but when you issue W-2Cs, you have to go back to the reconciliation again against the 941X. And again, this is your job, no matter who you outsource with or who you turn to help you. This job of reconciling always rests with the employer because the employer, again, is subject to those penalties. So going to the next slide, I do want to point out, again, that a failure to reconcile W-2 and 941 or W-2C and 941X does automatically result in a combined annual wage reporting or CWR penalty, and that is automatically 10% of the largest dollar amount, which is usually Medicare wages. And remember, you don't see this right away. It may take a few years for it to happen, so keep that in mind. On the next slide, we do point out some common W-2 reporting errors. You do want to make sure, go through this list. These are the ones that our clients come back to us every year, and they occur. So good just to put those on your checklist and make sure that you're reviewing them. Okay, let's go now and look at our final slide here, just to make sure that we've got the 4 steps to preparing the year-end down straight. Step 1, review your year-end checklist and keep in mind those earlier Form W-2 due dates. Second, identify all of your stakeholders, including third parties, and communicate with them what all of your deadlines are. This is really important, especially for third-party sick pay providers, and getting that statement in on or before January 15th. Third step, confirm that your pay and deduction codes are configured correctly for taxability and reporting. And this is a very important step. It gets skipped a lot. And imagine, if you get one earning code or deduction code wrong, that affects most of your workforce. That's a huge when it comes to W-2C time. And fourth step and last, reconcile wage and tax information for all federal and state jurisdictions. It's time-consuming, it's complicated, but it's so, so important to do. Okay, so moving on. I do want to, again, remind everybody that in your handouts there is, if you click on the cover for the year-end checklist, you can download the paper copy right there. It does include a lot of information that you'll want to be looking at as you prepare for your year-end filing. Okay, we're now going to go to a polling question. If you're a CPP or FPC and you want your RCH credit, don't miss answering yes to this polling question. And with that, Christy, I'll turn it back over to you.
Thanks, Debbie. Be sure to answer that polling question. And now we have a couple of common year-end reporting questions that we happen to see.
We have backup daycare that we provide in late December and may not have the information needed to include these benefits on the 2017 Form W-2. Can we use the special accounting rule? Unfortunately, the special accounting rule is not available for these types of benefits, and that employers will need to include the benefits provided through December 31st of 2017 on the 2017 W-2. Therefore, you will need to consider adjusting your cutoff date for your W-2 information with your third-party payroll provider, or possibly having to issue a 2017 Form W2C when you do have this information available. Some of the things that you may also want to consider would be a potential gross-up or a tax advance to avoid the W2C. Ken?
Thank you, Pete. One other question that we seem to get quite frequently around this time of year is our third-party provider files Forms W-2 for third-party sick pay using its own EIN, which is very common. So we don't report the sick pay on our 941. Are we responsible for paying unemployment insurance? Unfortunately, in this instance, typically a third-party payer will not pay or report your federal or state unemployment. So it's very important to, A, check your agreement, and B, work with your third-party provider to confirm that they're not doing it. And in most cases, that's likely going to fall back on the employer. So one thing to keep in mind at year-end.
Great. Thanks, Ken. Thanks, Pete. Appreciate that. Let me remind you to click on the green resources list icon at the bottom of your screen and download today's handout file. Let's do a quick 1-minute recap. Debbie, can you take us through that? I'm sure that everyone's interested in what we did with what's going on with tax reform.
Sure. So and just to recap some important things that we've talked about today, first of all, a lot of changes in the W-2 rules. Be sure you review the things that Stephanie talked about the W-2s and those new rules. Second, and I want to highlight a lot of state and local developments, and this trend will continue. So again, please look at the handout materials and look over all of the information that Pete and Ken shared, particularly some of the things that Pete talked about, a lot of new payroll taxes coming up, and a lot of trends that we're going to see, a lot of legislative activity in the next couple of years of things like family care type taxes, healthcare taxes coming up on the horizon. So these things to watch for. Then we move on to talk again about the disaster relief. Many of you have been affected. As Lee said, if you've paid benefits, take advantage of the federal tax credit. There's no point to leaving money on the table. Also, if you provided benefits, look over what you did provide and be sure this year end that you are excluding those benefits from taxable wages where you're allowed to. So again, you might want to look over the EY resource section, and there we do provide more detailed information about the various types of benefits and their tax-free status when you're in a hurricane-type situation. So that is a very important and hot topic this year. And then let's get back around to tax reform. Again, the House and Senate are now working towards conference committee where they will negotiate their difference. This could take up until the end of the month, keeping in mind that many of these effective dates are January 1 of 2018. So you do want to be watching closely. Hopefully you're in touch with us and receiving our alerts. But do watch carefully for changes. There could be little time to react. And even if some of these provisions don't make it into tax reform, I will say that since the early 2000s, there has been a strong eye towards the elimination of the tax-free status of fringe benefits as a way to raise revenue. So if we do skirt it this time, it is an ongoing concern. So that's the highlights of what we talked about today. Christy?
Thanks, Debbie. Again, let me remind you to click on the green resources list icon at the bottom of your screen and download today's handout files full of lots of great information that we've covered in the past hour and a half. It's loaded with extras you can refer to in the year-end and new year planning. And on behalf of everyone at the EY Workforce Advisory Services, I'd like to thank you, our audience, for joining us today. The archive of today's program will be posted on the Thought Center webcast homepage in about a week. This is also where you can view many of our other webcasts. And if you've been with us for at least 50 minutes, responded to the polling questions, and if you also complete the feedback, you can now download your education certificate by clicking on the CPE icon at the bottom of this interface. For CPPs and FPCs needing RCH credit, we will email your certificate provided you answered the required polling questions. We definitely pay attention to your feedback, so before you head off, please take a moment to open the red feedback icon and let us know what you thought of today's program. Thanks for listening.
This concludes today's conference call. You may